Question 1. Which of the following is a characteristic of proportional reinsurance? A. The reinsurer assumes a portion of the premium and the losses based on a fixed percentage of the policy. B. The primary insurer is responsible for retaining all of the losses above a certain threshold. C. The reinsurer pays only for losses that exceed a predetermined amount set by the treaty. D. The primary insurer maintains full responsibility for the claims and the reinsurer is only liable for administrative costs. Answer A. The reinsurer assumes a portion of the premium and the losses based on a fixed percentage of the policy. Explanation. Proportional reinsurance is where the reinsurer assumes a fixed percentage of both the premium and the losses from the original policy. This arrangement typically involves quota share or surplus share treaties. In a quota share arrangement, both premiums and losses are divided proportionally, such as a 70% 30% split between the primary insurer and the reinsurer. The other options describe non-proportional arrangements or situations that do not align with the typical structure of proportional reinsurance. Option B and C refer to non-proportional reinsurance, while D incorrectly describes a scenario where the reinsurer has no liability for losses, which is not a feature of proportional reinsurance. Question 2. Mr. Smith, a reinsurance broker in Florida, is tasked with selecting a reinsurer for a client. He must ensure that the reinsurer meets all Florida regulatory requirements. Which of the following actions should Mr. Smith prioritize to ensure compliance with Florida's laws? Only select reinsurer that has been approved by the Florida Department of Financial Services (DFS) and licensed to operate in Florida. B. Select reinsurer based on the client's preference without concern for licensing as long as the reinsurer is rated by a reputable rating agency. C. Choose reinsurer that does not have financial strength rating as long as the contract terms are competitive. D. Select any reinsurer based on its cost, as cost is the most important factor in Florida reinsurance contracts. Answer A. Only select a reinsurer that has been approved by the Florida Department of Financial Services (DFS) and licensed to operate in Florida. Explanation. Florida requires reinsurers to be approved and licensed by the Florida Department of Financial Services (DFS) in order to legally operate in the state. This ensures that the reinsurer complies with Florida's financial, solvency, and regulatory standards, protecting both the primary insurer and policyholders. Option B is incorrect because a reputable rating does not substitute for Florida licensing. Option C is incorrect because selecting an unlicensed reinsurer violates Florida's statutory requirements. Option D overlooks the importance of regulatory compliance, which is paramount in reinsurance contracts. Question 3. In a scenario where a Florida-based insurance company is using an excessive loss reinsurance treaty, which of the following statements is true about how the treaty functions? A. The reinsurer will cover a percentage of all losses incurred by the primary insurer, regardless of the loss amount. B. The reinsurer's liability is triggered only when the primary insurer's losses exceed specified retention limit, and the reinsurer covers losses above that amount up to the agreed limit. C. The primary insurer must pay fixed percentage of every claim under the treaty, while the reinsurer assumes all remaining costs. D. The reinsurer assumed the full amount of every loss after the first dollar, with no retention requirement for the primary insurer. Answer. B. The reinsurer's liability is triggered only when the primary insurer's losses exceed specified retention limit, and the reinsurer covers losses above that amount up to the agreed limit. Explanation. In excessive loss reinsurance, the reinsurer's liability is contingent on the primary insurer exceeding specific retention limit, the primary insurer's retention or deductible. This type of reinsurance is non-proportional, and the reinsurer losses only once they exceed their retention threshold. This arrangement is often used to protect the primary insurer against large catastrophic losses. Option describes proportional arrangement, which is not characteristic of excessive loss reinsurance. Option C is incorrect because it misrepresents how the treaty works, and option D inaccurately suggests there is no retention requirement, which is defining characteristic of excessive loss reinsurance. Question 4. Which of the following statements accurately describes the concept of risk transfer in reinsurance? A. Risk transfer involves the reinsurer assuming the primary insurer's risk exposure without any consideration for loss limits or premium. B. Risk transfer occurs when the primary insurer cedes a portion of its premium and liability to the reinsurer, transferring financial risk for certain types of losses. C. Risk transfer only applies to facultative reinsurance, as treaty reinsurance involves full retention of the insurer's risk. D. Risk transfer in reinsurance is irrelevant if the primary insurer has a strong solvency ratio and sufficient capital reserves. Correct answer. B. Risk transfer occurs when the primary insurer cedes a portion of its premium and liability to the reinsurer, transferring financial risk for certain types of losses. Explanation: in reinsurance, risk transfer occurs when the primary insurer passes part of its financial risk loss exposure to a reinsurer, typically through a treaty or facultative agreement. The reinsurer agrees to cover a portion of the losses, thus reduce primary insurer's exposure. Option is incorrect because risk transfer involves specified limits and premium considerations, not an open-ended transfer. Option C is incorrect because risk transfer applies to both facultative and treaty reinsurance. Option D is misleading as risk transfer is still important for managing risk even with strong solvency or capital. Question 5. Which of the following reinsurance pricing models would likely be most affected by changes in the frequency and severity of catastrophic events such as hurricanes? A. Proportional pricing models, where premiums are calculated based on a fixed percentage of the original policy's premium. B. Non-proportional pricing models, where premiums are determined by the risk of loss exceeding certain retention or threshold. C. Stop-loss pricing models, where premiums are determined based on the total losses of the primary insurer during a given period. D. Treaty pricing models, where premiums are adjusted based on the overall profitability of the reinsurance contract. Answer: B. Non-proportional pricing models, where premiums are determined by the risk of loss exceeding a certain retention or threshold. Explanation: non-proportional pricing models, such as excessive loss reinsurance, are highly sensitive to catastrophic events like hurricanes. These events can trigger large losses that exceed the retention limit, making the premiums in such arrangements volatile and heavily influenced by the frequency and severity. Catastrophic risks. Option as a proportional involves fixed percentages and is less impacted by specific catastrophic events. Option C, stop loss, relates to the total losses but may not be as specifically tied to catastrophic events as non-proportional models. Option D, treaty pricing, involves annual adjustments, but it doesn't focus directly on catastrophic losses in the same way that non-proportional models do. Question 6. Mr. Martinez is analyzing a potential reinsurance treaty that involves both proportional and non-proportional coverage. The treaty has a quota share agreement for proportional reinsurance and an excess of loss agreement for non-proportional reinsurance. Which of the following best describes how Mr. Martinez should approach the analysis of this treaty? A. Mr. Martinez should evaluate the proportional and non-proportional aspects separately, as the two types of reinsurance will operate independently. B. Mr. Martinez should consider the quota share as the primary coverage and use the excessive loss agreement as a secondary form of protection against catastrophic losses. C. Mr. Martinez should evaluate the non-proportional excessive loss reinsurance first, as it has a high priority covering losses. D. Mr. Martinez should not evaluate both aspects simultaneously, as combining proportional and non-proportional reinsurance is not common practice. Answer A. Mr. Martinez should evaluate the proportional and non-proportional aspects separately, as the two types of reinsurance will operate independently. Explanation: when analyzing a treaty that includes both proportional and non-proportional reinsurance, it is important to evaluate each aspect independently, as they cover different types of losses. Proportional reinsurance, like quota share, involves sharing both premiums and losses. Proportion to a fixed percentage. Non-proportional reinsurance, like excessive loss, comes into play when the losses exceed a retention threshold, and it only covers losses above that limit. Option B is incorrect because both aspects are equally important and should not be treated hierarchically. Option C is also incorrect as it doesn't take into account the separate nature of these coverage types. Option D is misleading. Combining proportional and non-proportional reinsurance is quite common. Question 7. In Florida, when a reinsurer becomes insolvent, which of the following best describes the primary role of the Florida Department of Financial Services, DFS? A. The DFS works with the failed reinsurer's creditors to negotiate debt repayment terms. B. The DFS ensures that the primary insurer can recover reinsurance claims directly from the Florida Reinsurance Trust Fund. C. The DFS will assume responsibility for paying all claims under the reinsurance contract. D. The DFS oversees the resolution process but does not have direct role in handling reinsurance claims or insolvency payment. Answer D. The DFS oversees the resolution process but does not have a direct role in handling reinsurance claims or insolvency payments. Explanation: in the event of reinsurer insolvency, the Florida Department of Financial Services (DFS) plays a supervisory role in overseeing the reinsurance company's operations and ensuring compliance with Florida's insolvency regulations. However, the DFS does not directly reinsurance claims or make payments. It is primarily responsible for overseeing the process of recovering assets and managing insolvency proceedings. Option is incorrect because the DFS does not handle debt repayment negotiation. Option B misrepresents the role of the DSOY. It may have a role in protecting the Florida Reinsurance Trust Fund. It does not guarantee claims recovery. Option C is also incorrect because it's the reinsurer's responsibility to settle claims, and the DFS does not take on this role. Question 8. Which of the following factors is most critical in determining the financial strength of a reinsurer in the context of Florida's reinsurance market? A. The reinsurer's overall market share in the global reinsurance market. B. The reinsurer's credit rating and solvency ratios, which indicate its ability to meet future claims obligations. C. The reinsurer's geographical diversification, as this ensures stability in Florida's hurricane-prone market. D. The reinsurer's history of claims payments to primary insurers over the past 10 years. Answer: B. The reinsurer's credit rating and solvency ratios, which indicate its ability to meet future claims obligations. Explanation: the financial strength of reinsurer is critical to ensuring that it can meet its future obligations, particularly in the face of large claims. Credit ratings from agencies such as A.M. Best and solvency ratios are key indicators of reinsurers' financial health. These metrics assess the reinsurer's ability to absorb losses and pay out claims in a timely manner. Option focuses on market share, which, while important, is less critical in assessing financial strength. Option C focuses on diversification but does not directly address solvency or claims-paying capacity. Option D discusses claims history, which is relevant but does not measure financial strength as effectively as credit ratings and solvency ratios. Question 9. Which of the following is the primary benefit of using a facultative reinsurance agreement for a specific high-risk policy? A. Facultative reinsurance guarantees that the reinsurer will cover all losses associated with the specific policy, regardless of the severity of the claim. B. Facultative reinsurance allows the reinsurer to selectively assume a portion of the risks associated with a particular policy, typically for high-risk exposures. C. Facultative reinsurance offers automatic coverage of all risks without the need for negotiation on each individual policy. D. Facultative reinsurance involves a blanket agreement that covers a wide range of policies without requiring individual assessments. Answer: B. Facultative reinsurance allows the reinsurer to selectively assume a portion of the risks associated with a particular policy, typically for high-risk exposures. Explanation: facultative reinsurance is a type of reinsurance where the primary insurer and the reinsurer negotiate coverage on a case-by-case basis, typically for high-risk or unique policies. This allows the reinsurer to selectively assume risks, providing protection for specific exposures. Option is incorrect because facultative reinsurance does not guarantee that the reinsurer will cover all losses, but the terms are negotiated for each policy. Option C describes treaty reinsurance, where coverage is automatically provided for a range of policies. Option D describes treaty reinsurance as well, which differs from facultative reinsurance in terms of negotiation and scope of coverage. Question 10. Which of the following statements best describes the purpose of a treaty reinsurance agreement? A. Treaty reinsurance is a non-negotiable agreement that covers all the policies of the ceding insurer automatically. B. Treaty reinsurance allows the ceding insurer to transfer risk for a specific policy to a reinsurer on a case-by-case basis. C. Treaty reinsurance is designed for specific high-risk policies and is not generally used for standard policies. D. Treaty reinsurance is a type of facultative reinsurance that requires negotiation before each policy is covered. Answer A. Treaty reinsurance is a non-negotiable agreement that covers all the policies of the ceding insurer automatically. Explanation: treaty reinsurance is an agreement where the primary insurer, ceding insurer, automatically transfers specified risks to the reinsurer for a defined period, typically without negotiating the terms for each individual policy. Option B describes facultative reinsurance, which is negotiated for specific policies. Option C is incorrect because treaty reinsurance applies to a broad set of policies, not just high-risk ones. Option D describes facultative reinsurance as well. Question 11. In a quota share reinsurance agreement, how are premiums and losses typically shared between the ceding insurer and the reinsurer? A. The ceding insurer and the reinsurer share both premiums and losses in proportion to a predetermined percentage. B. The ceding insurer retains all premiums but shares a fixed percentage of the losses with the reinsurer. C. The reinsurer covers all the losses but only receives a small percentage of the premiums. D. The ceding insurer covers all the losses but pays a fixed fee to the reinsurer for administrative costs. Answer A. The ceding insurer and the reinsurer share both premiums and losses in proportion to a predetermined percentage. Explanation. A quota share reinsurance agreement is a proportional arrangement where both the premiums and losses are shared between the ceding insurer and the reinsurer according to a fixed percentage. This helps reduce the risk exposure for both parties. Option B misrepresents how premiums and losses are shared. Options C and D describe incorrect terms for quota share agreements. Question 12. Which of the following is most likely to lead to a non-proportional reinsurance arrangement, such as excessive loss? A. The need to share a fixed percentage of all premiums and losses. B. The ceding insurer's desire to reduce its exposure to large catastrophic losses. C. The reinsurer's insistence on covering every policy individually. D. The desire to establish a fixed and predictable cash flow for the ceding insurer. Answer B. The ceding insurer's desire to reduce its exposure to large catastrophic losses. Explanation. Non-proportional reinsurance, such as excessive loss, is designed to protect the ceding insurer from large catastrophic losses. This type of reinsurance only comes into play when the loss exceeds a predetermined threshold. Option A refers to proportional reinsurance. Option C describes facultative reinsurance. Option D is more aligned with proportional reinsurance. Question 13. What is the primary risk management objective for a stop-loss reinsurance agreement? A. To share all premiums and losses on a proportional basis. B. To limit the ceding insurer's total losses for a given period, such as a year. C. To provide a layer of reinsurance protection only for catastrophic events. D. To reinsure a specific high-risk policy on an individual basis. Answer B. To limit the ceding insurer's total losses for a given period, such as a year. Explanation. A stop-loss reinsurance agreement aims to protect the ceding insurer by limiting its total losses during a defined period, usually a year. This type of reinsurance applies when the ceding insurer's losses exceed certain threshold. Option refers to proportional reinsurance. Option C is more descriptive of excessive loss coverage. Option D is facultative reinsurance. Question 14. Which of the following is a potential disadvantage of using facultative reinsurance for a large portfolio of policies? A. The process is slower and more administrative as each policy must be reviewed and negotiated. B. The ceding insurer is required to share a fixed percentage of premiums with the reinsurer. C. The reinsurer automatically assumes responsibility for all the policies in the portfolio. D. The ceding insurer can no longer choose to retain certain policies or risks. Answer A. The process is slower and more administrative as each policy must be reviewed and negotiated. Explanation. Facultative reinsurance is negotiated on a case-by-case basis, meaning it is more administrative and time-consuming compared to treaty reinsurance, where policies are automatically covered. Option B describes proportional reinsurance. Option C refers to treaty reinsurance, where policies are automatically covered. Option D does not apply to facultative reinsurance. Question 15. How does the excessive loss reinsurance differ from quota share reinsurance in terms of coverage? A. Excessive loss reinsurance covers losses only above a certain threshold, while quota share reinsurance covers a percentage of all losses. B. Excessive loss reinsurance applies a fixed percentage to losses, while quota share reinsurance provides full coverage. C. Excessive loss reinsurance is a proportional arrangement, while quota share reinsurance is non-proportional. D. Excessive loss reinsurance is primarily used for smaller policies, while quota share reinsurance is used for larger policies. Answer A. Excessive loss reinsurance covers losses only above a certain threshold, while quota share reinsurance covers a percentage of all losses. Explanation: excessive loss reinsurance is non-proportional and only covers losses above a specified retention threshold, whereas quota share reinsurance is a proportional arrangement where a fixed percentage of both premiums and losses is shared between the ceding insurer and the reinsurer. Option B is incorrect because excessive loss does not apply a fixed percentage to losses. Option C is incorrect because the two types of reinsurance are differentiated by proportionality. Option D is inaccurate as both types of reinsurance can apply to policies of varying sizes. Question 16. Which of the following factors is least likely to influence the cost of reinsurance for a ceding insurer? A. The historical loss experience of the insurer. B. The overall economic conditions affecting the insurance market. C. The reinsurer's solvency and credit rating. D. The legal and regulatory environment in the ceding insurer's jurisdiction. Answer: D. The legal and regulatory environment in the ceding insurer's jurisdiction. Explanation: while the legal and regulatory environment can indirectly influence the reinsurance market, it has less of direct impact on the cost of reinsurance compared to factors such as the insurer's historical loss experience, economic conditions, and the reinsurer's solvency and credit rating. Option A, B, and C are all factors that directly influence reinsurance pricing. Question 17. In the event of a reinsurer's insolvency, which of the following entities is typically responsible for managing the claims resolution process for reinsured policies? A. The state insurance department in the reinsurer's home jurisdiction. B. The ceding insurer, which assumes responsibility for paying all claims. C. The ceding insurer's policyholders, who will directly file claims with the reinsurer. D. The federal government, which provides backup for all reinsurance claims. Answer A. The state insurance department in the reinsurer's home jurisdiction. Explanation: in the event of a reinsurer's insolvency, the state insurance department in the reinsurer's home jurisdiction typically oversees the claims resolution process, working with the ceding insurer and policyholders. The ceding insurer may assume responsibility for managing the claims, but the state insurance department regulates the insolvency proceedings. Option B and C are incorrect, as the ceding insurer doesn't directly pay claims without oversight. Option D is incorrect because the federal government does not provide direct backup for reinsurance claims. Question 18. Which of the following is an advantage of catastrophe reinsurance for an insurer operating in a region prone to natural disasters? A. It helps stabilize premiums for customers by ensuring a consistent level of coverage during catastrophic events. B. It provides broad coverage for both low and high severity events, making it cost-effective for insurers. C. It only covers low-frequency events but excludes high-severity risks. D. It helps insurers cover the full cost of claims from major catastrophic losses without any deductibles. Answer A. It helps stabilize premiums for customers by ensuring a consistent level of coverage during catastrophic events. Explanation: catastrophe reinsurance helps insurers manage the financial impact of extreme events, such as natural disasters, by transferring the risk to a reinsurer. This helps stabilize premiums for policyholders, as insurers can better absorb large losses. Option B is incorrect because catastrophe reinsurance is typically focused on high-severity, low-frequency events. Option C misrepresents the coverage, as catastrophe reinsurance is designed to address high-severity risks. Option D is misleading because there may still be deductibles or retention amounts in catastrophe reinsurance agreements. Question 19. Which of the following reinsurance types is most commonly used for covering high-risk individual policies on a case-by-case basis? A. Treaty reinsurance. B. Facultative reinsurance. C. Quota share reinsurance. D. Excessive loss reinsurance. Answer B. Facultative reinsurance. Explanation: facultative reinsurance is used for specific high-risk individual policies, and coverage is negotiated on a case-by-case basis. This differs from treaty reinsurance, which covers all policies automatically, and from quota share reinsurance, which shares both premiums and losses proportionally. Excessive loss reinsurance is used for large losses exceeding a certain threshold, but it applies to larger portfolios rather than individual policies. Question 20. In a reinsurance context, what is the primary purpose of ceding commission? A. To cover the administrative costs of the reinsurance transaction for the reinsurer. B. To provide the reinsurer with a commission based on the total amount of premiums ceded. C. To pay a fixed percentage of premiums to the reinsured policyholders as part of their claims settlement. D. To cover the ceding insurer's expenses for acquiring the reinsurance coverage. Answer D. To cover the ceding insurer's expenses for acquiring the reinsurance coverage. Explanation. Ceding commission is paid by the reinsurer to the ceding insurer to cover the ceding insurer's administrative costs, acquisition expenses, and other expenses associated with acquiring reinsurance. Option is incorrect because the ceding commission is not designed to cover the reinsurer's administrative costs. Option B is inaccurate as it suggests commission based on premiums, not costs. Option C is incorrect because ceding commissions are not paid to policyholders. Question 21. In a surplus share reinsurance agreement, how is the amount of risk ceded to the reinsurer determined? A. The reinsurer assumes a fixed percentage of the insurer's total premiums and losses. B. The reinsurer covers losses exceeding certain amount up to specified limit. C. The ceding insurer retains specified portion of the risk and the reinsurer covers the remaining surplus. D. The reinsurer covers all losses above fixed amount, regardless of the insurer's original risk exposure. Answer C. The ceding insurer retains a specified portion of the risk and the reinsurer covers the remaining surplus. Explanation. In a surplus share reinsurance agreement, the ceding insurer retains a portion of the risk, typically up to a set limit, and the reinsurer covers the surplus. The reinsurer's responsibility increases as the size of the underlying risk exceeds the ceding insurer's retention capacity. Question 22. Which of the following is the primary advantage of using reinsurance for an insurance company? A. It provides the insurer with guaranteed profits, regardless of the underwriting results. B. It allows the insurer to retain all risks while still receiving protection from large losses. C. It helps an insurer increase its underwriting capacity and manage risk exposure. D. It eliminates the need for the insurer to set aside reserves for claims. Answer. C. It helps an insurer increase its underwriting capacity and manage risk exposure. Explanation. Reinsurance enables insurers to manage their risk exposure by transferring part of the risk to a reinsurer. This helps them increase their underwriting capacity, especially for larger or more hazardous risks. Option A is incorrect because reinsurance does not guarantee profits. Option B is incorrect because reinsurance transfers some risk to the reinsurer. Option D is misleading as reserves are still required even with reinsurance. Question 23. Which of the following best describes the purpose of facultative reinsurance? A. It automatically covers all policies issued by the ceding insurer for a defined period. B. It allows the ceding insurer to transfer specific high-risk policies to a reinsurer on an individual basis. C. It shares both premiums and losses in equal proportions between the ceding insurer and the reinsurer. D. It covers all risks except those that exceed a specified threshold of losses. Answer. B. It allows the ceding insurer to transfer specific high-risk policies to a reinsurer on an individual basis. Explanation. Facultative reinsurance is negotiated on a case-by-case basis and is typically used for specific high-risk policies that may not be covered under a treaty agreement. Option A describes treaty reinsurance. Option C refers to quota share reinsurance. Option D describes excessive loss reinsurance. Question 24. What is a retention limit in a reinsurance context? A. The maximum amount a reinsurer is willing to pay for a single claim or policy. B. The amount of risk the ceding insurer retains before reinsurance coverage kicks in. C. The minimum premium the ceding insurer must pay to retain coverage under the reinsurance agreement. D. The total amount of claims the ceding insurer can expect to pay out over a year. Answer. B. The amount of risk the ceding insurer retains before reinsurance coverage kicks in. Explanation. The retention limit is the amount of risk the ceding insurer is willing to retain beyond which the reinsurer will assume responsibility for additional losses. This amount is set to manage the insurer's exposure. Option. It describes the reinsurer's limit, not the retention. Option C is not correct because the retention limit is about risk exposure, not premiums. Option D is a general description of potential claims, but not related to reinsurance retention. Question 25. Which of the following best describes the favorable underwriting environment for reinsurance? A. High competition among insurers, leading to lower prices for policyholders. B. An increase in large catastrophic claims that lead to higher reinsurance prices. C. A rise in the availability of capital for insurers, allowing them to increase their underwriting capacity. D. A reduction in risk exposure, leading to decreased demand for reinsurance. Answer: C. A rise in the availability of capital for insurers, allowing them to increase their underwriting capacity. Explanation: a favorable underwriting environment for reinsurance occurs when insurers have access to sufficient capital, which allows them to underwrite more business without assuming excessive risk. This may lower reinsurance costs. Option is typically a result of market conditions, not necessarily a favorable underwriting environment. Option B reflects an unfavorable environment. Option D suggests low reinsurance needs, which would not indicate a favorable environment. Question 26. Which of the following is a key feature of a proportional reinsurance agreement? A. The reinsurer covers only losses that exceed a predetermined amount. B. The ceding insurer and reinsurer share both premiums and losses based on a fixed percentage. C. The ceding insurer retains all premiums, but the reinsurer covers all losses. D. The reinsurer takes responsibility for losses on an individual policy basis. Answer: B. The ceding insurer and reinsurer share both premiums and losses based on a fixed percentage. Explanation: proportional reinsurance agreements involve both the ceding insurer and reinsurer sharing premiums and losses in proportion to a predetermined percentage. Option A refers to non-proportional reinsurance. Option C is not typical of proportional reinsurance. Option D describes facultative reinsurance. Question 27. Which type of reinsurance is typically used to protect an insurer from catastrophic events, such as natural disasters or large-scale accidents? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Surplus share reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is designed to protect the insurer from catastrophic events by covering losses above a certain threshold. Option is incorrect because facultative reinsurance is used for individual policies. Options C and D refer to proportional reinsurance arrangements, which are not as focused on catastrophic events. Question 28. In a reinsurance agreement, what does the term retrocession refer to? A. The process of reinsuring a policy that was previously ceded to a reinsurer. B. The process of transferring part of the reinsurance risk to another reinsurer. C. The payment made by the ceding insurer to the reinsurer for administrative costs. D. The recovery of losses that were paid out by the reinsurer to the ceding insurer. Answer: B. The process of transferring part of the reinsurance risk to another reinsurer. Explanation: retrocession refers to the practice where a reinsurer transfers part of the risk it has assumed to another reinsurer. This is done to manage its exposure. Option: it describes the process of reinsurance, but retrocession involves passing on risk. Options C and D are incorrect as they do not describe the retrocession process. Question 29. Which of the following would most likely lead an insurer to increase its use of reinsurance? A. A decrease in the frequency of claims. B. A significant increase in policyholder premiums. C. A desire to reduce capital requirements and increase risk capacity. D. A reduction in competition from other insurance companies. Answer: C. A desire to reduce capital requirements and increase risk capacity. Explanation: insurers often use reinsurance to reduce the capital they need to hold, which allows them to increase their risk capacity and underwriting potential. Option A would likely reduce the need for reinsurance. Option B is unrelated to reinsurance usage, as premiums do not directly influence reinsurance needs. Option D may lead to reduced demand for reinsurance, but not necessarily increased use. Question 30. Which of the following is a key difference between excessive loss and a stop-loss reinsurance? A. Excessive loss reinsurance covers losses exceeding a certain threshold, while stop-loss reinsurance limits total losses for a given period. B. Stop-loss reinsurance covers losses above a predetermined threshold, while excessive loss reinsurance provides coverage for catastrophic events only. C. Excessive loss reinsurance is proportional, while stop-loss reinsurance is non-proportional. D. Stop-loss reinsurance covers individual policies, while excessive loss reinsurance covers entire portfolios of risks. Answer A. Excessive loss reinsurance covers losses exceeding a certain threshold, while stop-loss reinsurance limits total losses for a given period. Explanation: excessive loss reinsurance provides coverage only for losses that exceed a predetermined amount, while stop-loss reinsurance limits the total losses for an insurer over a given period, such as a year. Option B mischaracterizes the types of coverage. Option C is incorrect because both are non-proportional reinsurance. Option D is incorrect because stop-loss does not cover individual policies.